In about 10 hours, a U.S. naval blockade goes into effect across Iran's entire coastline, and there are 230 loaded oil tankers sitting in the Gulf right now with nowhere to take their cargo. Good morning. It's Tuesday, July 14th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. And because today is, by a wide margin, the loaded morning we've been building toward all week, we've pulled Sarah Mitchell into the fourth chair. Oil's a story underneath every other story today, and that's Sarah's beat.
Morning all. Happy to be back. Wish it were for a quieter reason.
Quiet's not really on the menu today.
It is not. Quit business first, because I want to get this out of the way before we bury it. Eleanor, Marcus, season record.
Still 2 wins, 2 losses, streak of -1 for me.
2 and 4, streak of +1 holding.
And nothing moves today because both of yesterday's calls, Eleanor's Wells Fargo margin plus CPI, Marcus's Micron close, resolve at the end of today's session. We're taping before the opening bell, so there's literally nothing to grade yet.
Which is almost funny because today is the exact session those calls were about. We built the anticipation and then have to sit through it ourselves.
Welcome to the other side of a preview show.
One more piece of housekeeping, because it's a nice bookend. 3 straight episodes we had the bank earnings date wrong, correcting ourselves show to show, and the correct answer turned out to be today. So today is actually the day. Let's not get it wrong a 4th time.
I've triple-checked. It's today.
Good. Let's start with what actually happened yesterday, because Monday didn't just set up today. It broke some things on its own. Eleanor, walk me through the close.
It was uglier than the headline number suggests. S&P fell 60 points, 0.7% to 75.15. Nasdaq took it worse, down about 1.5%, 400 points to 25,873. Dow barely felt it, down 0.25% because energy was up big and offset almost everything else.
So 3 very different days wearing one index number.
Right, and the VIX tells you which one was real. It jumped almost 14% to just above 17. Its sharpest single-day move in weeks. That's not a market shrugging this off.
Here's the part I actually want to flag because it's the weirder story under the obvious one. Gold fell too. Down about 2.5%. On a day, oil spiked 9% and stocks sold off. That's not how a risk-off day is supposed to work.
Explain that for people who assume gold just goes up when everything else goes down.
It's supposed to. That's the textbook. What happened yesterday is traders read this specifically as an oil and inflation story rather than a generic flight to safety story, so the dollar caught the safe haven bid instead, and gold got sold partly on profit-taking after its own recent run. Bitcoin fell too, down about 3%, trading with risk assets, not against them. Same as it's done through most of this whole episode.
Which is the tell that this wasn't blanket panic. It was a specific, targeted repricing of oil risk and of one very specific corner of tech.
Give me the sector map quickly before we go deeper on any one piece.
Energy, obviously, the one clean winner. Oil-linked names rallied straight through on the crude spike. Tech was the clear laggard, chips absorbing almost all of it. Communication services and the mega-cap names held up noticeably better. Apple in particular didn't trade like the rest of growth, which tells you investors were rotating within tech rather than dumping it wholesale.
And small caps didn't get the memo that this was supposed to be a contained chip-specific story. Russell down closer to a full percent, underperforming the majors. When the small cap complex sells off alongside a targeted sell-off, that's usually your sign it wasn't as targeted as the index headline made it look.
Hold that thought, because that's exactly where I want to go next. And it closes a loop from yesterday's show. You two ended Monday's episode with an actual disagreement on the air. Unresolved. Eleanor thought the chip sell-off was the first real crack in a narrower than it looked rally. Marcus, you thought it was memory names getting sold first in a risk-off morning while the real multi-year contracts held. You set a test if Applied Materials and Broadcom traded flat or green while Micron and SK Hynix stayed deep red. That's Eleanor's case. If everything got sold together and then recovered together, that's yours.
I remember exactly what I said.
So, we have Monday's actual close now. What happened?
Applied Materials fell. Intel fell. AMD fell. The notes are explicit. Each fell alongside the broader chip complex. That's not equipment holding up while memory got hit. That's the whole group getting sold together.
Huh. I'll give you that one. That's closer to your case than mine. Everything read together is actually the less comfortable outcome for my argument, not the more comfortable one.
Why less comfortable? Walk the listener through why everything fell together cuts against you specifically.
Because my whole point Monday was that the equipment and custom silicon names are tied to signed multi-year contracts and shouldn't trade like a risk-off basket. If Applied Materials sells off on an Iran headline that has nothing to do with its backlog, that's the market treating the entire AI complex as one crowded trade instead of four distinct ones, which is closer to what Eleanor has been arguing for 2 weeks now.
I'll take the point without spiking the ball. One day doesn't fully settle it. We still need to see if equipment recovers faster than memory over the next week, which was always going to be the real tell. But yesterday leaned my way.
Noted, on the record, and we move on. That's how you score a debate honestly, not by pretending it's still 50-50 when it isn't. Let's go to the name that actually drove that sell-off, because it deserves its own conversation. Marcus Skay Hynix.
It's a remarkable 4 trading days. Thursday, this stock debuted on the Nasdaq at $149, popped 13% out of the gate, raised $26.5 billion, the largest U.S. listing ever by a non-U.S. company. Monday, the sole-listed shares fell as much as 15%, the worst single session in the company's history, dragging the KOSPI down 9% and triggering a trading halt.
What actually broke? Give me the mechanism, not just the number.
A South Korean brokerage cut its own second quarter profit estimate for the company about 8% below consensus, and the reason was specific. HBM4 shipment volumes aren't ramping as fast as the market had priced in. Full-scale mass production is now expected in the third quarter, not the second. That's a timing slip, not a demand collapse, but a stock priced for a flawless ramp doesn't need a demand collapse to get hit. A timing slip is enough.
And it wasn't contained. Micron fell in sympathy, down over 5%. SanDisk, Western Digital, Seagate all took real damage. The Nasdaq-listed shares gave back roughly 8%, still above the IPO price, but a long way from Friday's high.
Bull case, bear case, give me both, fast.
Bull case, I actually think it holds up. One asset manager I saw quoted said the demand cycle runs into 2027-2028 regardless of one quarter's shipment timing, and another analyst flat out called the stock oversold and said further weakness is a buying opportunity. HBM pricing power isn't the thing in question here. The calendar is.
Bear case, and it's not really about SK Hynix specifically. It's about what a stock arriving priced for perfection tells you about positioning across the whole AI trade. When a name pops 13% on an IPO and then gives back its entire honeymoon in 3 sessions on a single timing report, that's scarcity-driven money, not conviction money. And scarcity money runs first every single time something like an oil shock hits the tape.
I don't disagree with that read of the flow. I disagree that it tells you anything about the semiconductor thesis itself.
Where does this actually go from here? Who's the next domino if there is one?
Micron's next quarterly print becomes the cleanest read the market's got on whether HBM demand is genuinely softening or whether this was one Korean brokerage note. Samsung's already pushed its own HBM4 rollout later into this year, so it's not operating on a totally separate narrative. It's a related but distinct story investors are going to keep conflating whether they should or not.
And the equipment names ASML, ASME, BC are watching the same thing from the capital spending side, but the name everyone's actually waiting on is NVIDIA. The whole memory complex is now trading on the assumption that the Rubin generation ramps roughly on schedule. Any commentary out of NVIDIA on that timeline moves SK Hynix and Micron more than either company's own numbers would.
Which is exactly my discomfort with the bull case. An entire $1 trillion adjacent trade is now sensitive to one company's roadmap slip.
That's fair, and it's also just how a supply chain works. It doesn't make the demand fake.
So the split is this the trade breaking, or the trade's newest, most excitable participants getting flushed out?
That's the honest version of it, yes.
All right, let's bring in the other half of yesterday's story because it's actually gotten bigger overnight, not smaller. Sarah, you weren't with us Monday, but Eleanor mentioned your line in the sand. No confirmed hit yet on an actual loaded crude tanker. Where do things stand this morning?
Still no hit on a loaded tanker, so technically my line hasn't been crossed. But I want to be honest. The line itself just got a lot less relevant. Because the mechanism changed overnight.
How so?
Quick timeline, because it matters. There was a ceasefire holding since June. Part of a 60-day window the US and Iran had set to actually negotiate final terms. That window's roughly at its halfway point. Over the weekend, Iran's Revolutionary Guard hit a commercial vessel in the Strait. US Central Command answered with strikes on more than 80 targets inside Iran, and Iran retaliated against sites in Jordan, Kuwait, and Qatar. So we're not talking about a fresh conflict. We're talking about a negotiation that was already fragile, breaking in the worst possible way, at the worst possible time on the calendar.
And now the blockade.
And now the blockade. President Trump announced the naval blockade is going back into effect, plus a 20% toll on any cargo that transits the strait without U.S. authorization. It kicks in today, 4 p.m. Eastern. It covers Iran's entire coastline, every port, every oil terminal. Any vessel entering or leaving without clearance gets intercepted and seized. That's not a threat anymore. That's a policy that takes effect this afternoon.
Wait, this afternoon? Today? During our own show session?
Today, 4 p.m. Eastern.
Give me the number that actually tells me how bad this already is, not the headline.
230 loaded oil tankers are sitting in the Gulf right now with nowhere to deliver. Traffic through the strait has collapsed from somewhere around 18 to 22 vessels a day down to 6 in a 12-hour window a few days ago. Roughly a fifth of global oil consumption normally moves through that choke point. You don't need a single missile to hit a tanker for this to matter. You just need ships sitting still.
Which is exactly why oil moved the way it did yesterday without an actual strike on a crude cargo. WTI up almost 9%, Brent above 83. The market's pricing the blockade, not waiting for casualties.
Correct. And that's the distinction I'd want listeners to hold on to. My original line, a hit on a loaded tanker, was a proxy for has this crossed from posturing into physical risk. The blockade taking effect this afternoon arguably crosses that line without needing a single explosion. A ship sitting idle for a week is a real economic cost even if nothing gets fired at it.
Devil's advocate, because somebody should ask it. Is there a version of this where the blockade is mostly theater, announced loudly, enforced loosely, and oil gives some of this back once nobody actually gets seized?
There's absolutely a version of that. We've had 4 weekend flare-ups in 3 weeks that each looked terrifying Sunday night and faded by Wednesday. I'm not going to pretend this is definitely different. What I'd say is the blockade is the first of those 4 episodes with an actual enforcement mechanism attached to a specific clock 4 p.m. today, instead of just harsh language. That's new, and it's why I'm not ready to call this one theater yet.
What do you need to see today, specifically to know which one it is?
Whether an actual seizure happens in the first few hours after 4 p.m., or whether ships quietly find a way through with insurance premiums doing the work instead. If we get to tomorrow's show with 0 seizures and tankers already rerouting to with paid tolls, that's the market's relief valve. If a seizure actually happens, oil doesn't fade, it extends.
That's about as clean a today-specific test as we've had all summer. All right, this is exactly why this morning's data was always going to matter more than most. Let's build it, because there's a 90-minute window today that's about as stacked as this show has ever previewed. And Lenore, take me through it.
June CPI lands at 8:30. 5 banks, JP Morgan, Bank of America, Citigroup, Goldman Sachs, Wells Fargo, report before the open same morning. And new Fed Chair Kevin Warsh testifies before the House Financial Services Committee at 10, his first appearance since taking the gavel, roughly 90 minutes after that CPI number prints.
Consensus on the number?
Headlines expected around 3.9% year over year, down from May's 4.2. Core around 2.9. Goldman's actually leaning a touch below consensus on both. One of their economists sees core ticking down to 2.8, headline closer to 3.87.
So a good number is plausible.
A good number on paper is plausible. The complication, and it's the same one from yesterday's setup, is that most of this data was collected before the weekend's oil spike. If the tape wants to read this as confirmation that inflation's cooling, it's reading a snapshot that predates the thing that could re-accelerate it. August's report is the one that'll actually reflect a 9% oil move.
Which means today's number could print soft and still not be the all-clear it looks like on the surface.
Banks, give me the actual numbers, not just they report.
JP Morgan's expected around 544 to 562 a share, revenue in the high 40 billions. Bank of America closer to $1.11, $12, revenue around 30 billion. But the number that actually matters to the market isn't EPS, it's net interest margin and credit commentary. Options are pricing single-day moves from 4.4% on JP Morgan up to 6% on Goldman. That's earnings season opener volatility, and Wells Fargo's margin specifically is my call from yesterday still sitting out there unscored.
My caveat from yesterday still stands too, and I'll say it again because today's the day it actually gets tested. Good margin doesn't matter if loan loss provisions are quietly getting worse underneath it. Everyone's going to fixate on the spread number this morning and might miss it if credit quality's rolling over somewhere in the small business book. Investment grade spreads and high yield spreads have both been sitting near multi-year tights. If that starts to widen alongside today's numbers, that's a much bigger story than any one bank's headline beat.
Agreed, and it's the one number I'd actually watch over any single EPS line today.
And Warsh has to stand in front of a committee 90 minutes later where roughly half the members are already on record wanting another hike, and say something coherent about whatever that CPI print just said, with the bank numbers and an oil shock sitting in the room with him.
That's not an easy chair to sit in for anyone. Why does his specific testimony carry more weight than a normal Fed appearance?
Because markets don't have a track record on him yet. With the prior chair, you knew the framework, you were parsing word choice at the margins. With Warsh, today is partly the market building the framework itself, in real time, off however he handles a hot number in front of a hostile room. First impressions on a new Fed chair tend to stick for months.
Which raises the stakes on him saying almost nothing interesting. The safest path for him today is to be boring on purpose, and if he can't manage that with a hawkish committee and a scary oil print in the room, that itself becomes the story.
That's not an easy chair to sit in.
No, it is not.
So here's the actual disagreement I want to put on the table for today, because I don't think you two agree on how this resolves, and I'm not going to force it. Eleanor, you read?
I think this is a legitimate stagflation setup, not a one-day scare. You've got an oil shock landing directly on top of an inflation print, a hawkish committee, and a Fed chair who's never testified before. That combination doesn't usually get shrugged off by Wednesday. My honest expectation is yields push higher today regardless of what CPI actually says, because the oil story overrides a backward-looking number, and duration-sensitive names, chips very much included, have a rough session.
I think that's the scarier story, and I think it's wrong, or at least early. We've had 4 almost identical setups this summer, geopolitical scare plus a loaded data morning, and every single one has faded within 48 to 72 hours once the initial data actually printed and turned out fine. My actual expectation is CPI comes in roughly in line or better. Banks post solid margins, Warsh does something carefully boring, and by Wednesday afternoon this whole morning reads like a one-day flinch.
So the tiebreak, for anyone listening who wants a concrete thing to watch, if the 10-year is meaningfully higher by the close today, regardless of the CPI print, that's Eleanor's stagflation case building. If yields settle back down once the numbers actually digested and banks trade calm into the afternoon, that's Marcus's fade by Wednesday pattern holding again.
I can live with that as the test.
Same. Genuinely don't know which way today breaks. First time all summer I'd call it close to a coin flip.
Good. That's an honest answer, and it's rare from you. Let's take 30 seconds for something that has nothing to do with any of this. I filled up on the way in this morning and the pump had already moved. Small preview of what a 9% oil day actually costs a normal Tuesday.
Welcome to my inbox for the last 3 weeks.
The economy? Everyone. Very abstract until it's your gas tank.
Fair. Back to the tape. Closing calls. One specific and checkable thing each for today's close. Eleanor Ye.
If core CPI comes in anywhere north of 0.3% month over month, I think the 10-year breaks 4.65 today and holds through the close, regardless of what the bank numbers say individually. That's my stagflation case, made concrete.
Marcus.
SK Hynix's Nasdaq shares close back above 160 today. If a name that's already given back most of its IPO pop can rally through a day with genuinely scary oil and geopolitical headlines, that tells you the flush was flow, not fundamentals, and I think it happens.
Sarah, you got a fourth chair and a checkable call if you want one.
I'll take it. Rent closes back under $80 today. Not because the blockade isn't real, it is, but because a policy with a 4 p.m. start time and no confirmed seizure yet is still, for now, a risk premium sitting on top of the price rather than an actual supply loss. If I'm wrong and it holds above 80 into the close, that's the market telling you it stopped pricing this as a scare and started pricing it as a fact.
3 calls, 1 clock, all resolving by tonight's close. We'll have real numbers on all of it by tomorrow morning, not previews. So here's today, CPI at 8:30, 5 banks before the bell, Warsh in front of Congress at 10, and a blockade that takes effect at 4 p.m. Eastern with 230 tankers already stuck waiting on it. Watch the 10-year, watch Brent, watch whether the chip complex trades as one crowded basket again or actually splits this time. And it doesn't let up once today's close. PPI lands tomorrow as the follow-on inflation read, retail sales and jobless claims Thursday alongside Netflix and United Health earnings. Housing and industrial production close out the week Friday. This is a full week, not a one-morning story. If the show's useful heading into a stretch like this, find our written notes at novaventures.us. We'll have the full breakdown up as it happens. That's your Nova Ventures Morning Brief. Have a great Tuesday, and we'll see you tomorrow.